We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Puplava, CIO at Financial Sense Wealth Management. How are you today, Chris?
I'm doing well. Thanks for having me on the show.
Great to have you here. So, Chris, you recently took a deep dive into points at which the Fed stops raising rates in past cycles. So, have all the past rate hiking cycles ended in recession?
No, there are a few exceptions to that. We had an exception in the mid-1980s. We also had an exception in the mid-1990s. So when you look at the last 9 Fed rate cycles, 7 out of those 9 did end up in recession. And one of the things I think was different about the mid-80 and mid-1990 slowdowns, which did not end up in recession, was that, number one, economic growth was on a secular basis on a strong footing. And then second, you had still some room, spare capacity for economic growth. The unemployment rate was still well above the long-term natural rate of unemployment. And so there was still some labor to be squeezed out of the market, still some job growth that was possible. And really, that was probably the biggest thing that was different in those two slowdowns versus the actual outright recessions. However, when we look at the Fed raising interest rates, when the current unemployment rate is below the long-term natural steady state of unemployment, that basically is telling you that we've overshot our potential. And there's really no spare capacity to squeeze out of the economy to continue to see growth. And that's where we are today. So one of those key elements that was present in those prior slowdowns is not there today. So the Fed really does, have to walk that fine line. And that's what Paul Volcker did back in the 70s, is to tame inflation. He caused 2 recessions back to back within a 2-year time span. He really had to crush aggregate demand to bring inflation under control. And the Fed may have to do that. The one different thing that we're kind of seeing over the next year is that we do have the November elections coming up. So, you cannot say that the Fed's apolitical. I clearly think there's some issues there. Mm-hmm. Trump was yelling and screaming at Powell before, and then we've got the Biden administration screaming at him about inflation. And so I find it hard to believe that the Fed will be tightening as aggressively as they are projected to, going all the way into the November elections, because we are seeing financial conditions tighten. We are seeing the economy slow. Often at times, the Fed is raising rates just as the economy is peaking or is still accelerating. In the present case, the Fed started raising rates with such a lag that we already saw a peak in a lot of growth rates for the economy, manufacturing growth rates, annual employment growth rates. So the economy was already slowing before Powell raised rates for the first time in March of this year. And the economy is going to continue to slow based on prior tightening in monetary policies in financial markets in terms of interest rates, market rates like the 10-year Treasury and so forth. They filter in. Just look at mortgage rates. We're seeing a massive jump in mortgage rates start to impact the National Association of Home Builders Index, which we just got today for last month. And that is at, I believe, a 2-year low. So we're seeing housing rolling over. We're seeing manufacturing rolling over. Job growth was already slowing. And so for the Fed to raise rates as aggressive as they are, I find that hard to believe. And an interesting note, since the Volcker Fed of the 1970s, we've had progressively more debt, whether that's corporate debt, government debt, or household debt. And so the pain threshold when the Fed starts raising interest rates has become lower and lower with each cycle. And so what we found is when the Fed raises rates, every time it peaks at a lower rate than the prior cycle. Well, if you look at 2018, the Fed ultimately raised rates to about 2.25% to 2.5%. And if the Fed raises rates as much as the market is pricing in, the Fed will exceed that later this year. This will be the first time since the 1970s that the Fed raises rates above the prior rate raising cycle. So
if we see it.
Exactly. If we see it, if something doesn't break before then, I mean, as much as the Biden administration is wanting the Fed to do something about inflation, I think it's going to want the Fed to do something about financial markets as we head into November if they don't start, slowing the pace of rate hikes.
Mm-hmm. So, something that you and I had kind of discussed before we hit record here today was the fact that it really seems like the Fed is in some ways going after the wrong side of the equation, really, in the inflation story. So do you think that raising rates is going to have a direct effect of any sort on inflation at this point?
Honestly, the main component or the issues that we're dealing with inflation are on the supply side. And we've continued to have shock after shock. I mean, obviously with China shutting down, that's clearly impacting the supply chain. But, Jerome Powell cannot do anything about, the supply of commodities, for example. One of the things that is really atypical is this last recession. Part of the problem, in my opinion, was when everyone stayed home, we basically stopped spending money on services and we spent money on goods, on tangible things. And so we're all at Amazon ordering TVs or computers or you name it, that involves manufacturing. And so we saw a, continued high level of manufacturing activity compared to a typical major drop off during a recession. And when you have a recession, you typically see demand fall, not rise. And because demand falls, you start to see inventories build of all things, whether that's clothing or you name it. But in particular, you typically see inventories of commodities build up. And during the COVID-induced recession, commodity inventories did not see a build at all. And when you look at base metal inventories, it doesn't matter if you're looking at copper, aluminum, lead, zinc, cobalt, tin, the inventory levels that we are seeing right now are probing the bottoms, or if not hitting the lows over the last few decades. And it takes a long while. There's a big lead time between the investment to increase production and the actual output of that. And so I think we're going to see commodities remain elevated. We obviously still have the risk with Russia. And part of the problem for the US is with Europe turning away from Russian energy. Well, that means we're going to start seeing more exports from the US, whether that's refined products, natural gas, or oil. We're basically helping Europe out, which puts stress on our inventories. You look at gasoline, diesel, distillates, natural gas, coal, just about any major energy source fuel is probing the lows, or if not setting new 5-year lows for this time of year. If you look at the East Coast, they're setting record low inventories for distillates. So you're seeing a big jump in distillate prices on the East Coast. And so for me, I think inflation is going to remain sticky. I do believe it will moderate just from the base effect, looking at the comps from a year ago, because it really wasn't until the spring of 21 that we saw inflation, at least by the consumer price index, pick up. In early 21, believe it or not, inflation was roughly 2% or lower. So the big jump in the consumer price index happened in the summer. So obviously the comps are going to start to moderate from that standpoint. But with oil breaking out of a recent consolidation since the initial Russian invasion of Ukraine, oil prices are going to remain elevated. So for me, looking at the Fed, I really do think there's only so much they can do. And I do think with, significant backlogs that we're seeing because of supply chain issues, I honestly don't know how much aggregate demand will decline. For me, I think that before we get the inflation rate that Powell is looking for, I think we're going to have some disruptions in the financial markets due to the amount of tightening. And I think the Fed will be responding to that before it sees inflation where it wants.
Yeah, those inflation comps versus a year ago are going to start coming down while the relative price level is going to stay up, right?
Correct.
Mm-hmm. So getting back to kind of the original question that I had for you, at what point does the Fed typically, let's say, reverse course? We always hear that they will stop tightening financial conditions when something breaks. So what do you think some of those points are where they see something, quote unquote, breaking?
Sure, that's a really good point, and that's ultimately what ends up happening. They do, basically have a plan of where they think they're going to go until something dramatically changes. A good example of that was Janet Yellen, who led the Fed before Powell. In 2016, at the end of 2015, looking at their projections for 2016, the Fed was basically projecting that they would raise rates 4 quarter point hikes in 2016. Roughly one rate hike a quarter. The Fed only raised rates one time, and that was at the end of 2016. So at the time, we were dealing with a global slowdown. The dollar was relatively strong. China in the summer prior in 2015 devalued their currency because of their slowdown. So the Fed can have plans, but we end up seeing that they really have a lack of foresight and their plans are way too aggressive. And as you said, we typically see something break. So I thought it would be interesting looking at just, recent memory, the last few times where the Fed kind of pivoted or, we had a Powell pivot, so to speak. Mm-hmm. And one of the most recent ones we had was in 2018. If you remember in 2018, and I think that's a good year to compare to, the Fed was not only raising interest rates, but the Fed was also shrinking its balance sheet as it's just about to start doing next month. And so it basically was tightening on two fronts, the balance sheet impact and then the interest rate level. And we started to see the market crack in the fourth quarter of 2018. The market had peaked. We started to see some stress in junk bonds, other measures of credit stress were starting to build. The weakest area of the markets were starting to fall pretty precipitously. And we had the last Fed meeting of the year was December 18th. And just to kind of show you, how delayed the Fed is in terms of understanding what is going on around them. On December 18th, the Fed raised rates a quarter point, and the Fed just basically said that their balance sheet reduction was going to be on autopilot heading into 2019, and that it would be as boring as watching paint dry. So basically, the Fed was communicating that they would have no impact by shrinking their balance sheet and withdrawing liquidity on financial markets, that it would be a non-event. Well, before the Fed said that, one of the things that we started to see was a dramatic decline in junk bond issuance in the US in November, in the prior month. Prior to that, companies that were sub-investment grade were issuing tens of billions of dollars of new debt each month. That really began to slow to a crawl in November as buyers were beginning to step away as they were basically concerned about potential default risk and credit spreads widening. And then things really began to seize up in December of 2018. So to give you an example, we still had a decent amount of debt issued in November of 2018, but by December 3rd of 2018, that was the last junk bond that was issued, while every other scheduled debt that was supposed to be launched on the market was pulled. Basically, the junk bond market seized up and there were no more deals that were being processed. And that deal was literally for only $3 million. It was just under $3 million. It was a puny deal, and it was for Ally Financial. That occurred on December 3rd of 2018, the very first business day of the month. There was not a single deal that got done for the rest of the month. So December 3rd, the last junk bond deal is done. Obviously, deals are being pulled, stress is building, and the Fed didn't have a clue. It took 2 weeks, and the Fed was basically raising rates still and saying that they were going to continue shrinking their balance sheet. It was only based on that communication that the Fed didn't see any issue with the building stress in the markets that we saw the stock market really tank in the final 2 weeks of the year. And then ultimately, we got the Powell pivot in early the first week of January of 2019, where Powell, Yellen, and Bernanke all appeared together in an economic forum. And at one point where 2 weeks prior, Powell was saying they were going to shrink their balance sheet on autopilot, he's now communicating that the Fed would do whatever it takes to stabilize financial markets and would use all the tools at its disposal. So clearly a huge turnaround. But the problem was from early December to late December, this wasn't front page news. So this was occurring behind the scenes. There was a seizure. Unless you're in that market, it really didn't become front page news until later that month. So consequently, it was only when the Fed saw that on the front page that it started to react. And we started to see something also in 2019. In 2019, we had the repo crisis. And so what we saw in the September of 2019 was that by the Fed shrinking its balance sheet, it was effectively taking reserves out of the system, and reserves in the banking system became so thin that we had a spike in secured overnight rates over the federal funds effective rate, where that spread jumped by 300 basis points. It's typically zero, give or take. So there was a dramatic spike in the system, and immediately the Fed responded, and it went from shrinking its balance sheet to expanding it and printing money. But that was an overnight thing where something broke. Basically, it's only when there's a clog in the US financial plumbing system that the Fed responds. And so when I'm looking at the present case, I don't feel we're there yet. And that's why I think the current rally that we're having over the last week, in my opinion, is likely going to be turning out to be a dead cat bounce.
So, Chris, when we're thinking about all of these different, let's say, pieces of data that the Fed watches, what is the ISM and why does the Fed watch it so closely?
The Institute of Supply Management, or ISM, they've been around, I believe, even before World War II or thereabouts. So they've been around a long time. It's great because there's a lot of history there to kind of see how it's acted around recessions, expansions, contractions. And essentially what it is, it's a survey where the Institute of Supply Management surveys hundreds of businesses and asks them a series of questions. And based on the respondents' answers, it comes up with an index. And they normalize it around 50. So any number over 50 shows net growth. Any number below 50 represents contraction. And so typically what we see, and often at times, is that a lot of these issues that we see where there's problems in the financial plumbing or there's something broken, you don't see that when money is flowing. You don't see that when the economy is growing robustly. It's, as Warren Buffett said, it's only when the tide goes out do you see who's been swimming naked. Mm-hmm. And even if you think about it, that's even kind of in the financial crisis. Essentially, as long as the economy is growing, it can absorb most shocks. But, when the economy is weak, it's vulnerable to a shock really sent into overdrive on the downside. A good example of that was housing more or less peaked in 2005. We were starting to see home building activity slow, home price appreciation slow. And then you started to see financial companies in 2006 start to have issues. And then in 2007, we're starting to see the market roll over. But overall, the economy really was kind of humming along, not really in dire straits. But when the market was vulnerable, or the economy was vulnerable, it was when Bear Stearns blew up. And it's kind of like kicking the patient when it's down, it's harder to get back up again. And that's similarly when you see the economy rolling over to basically a stall state or slightly contractionary territory, that's when it can't absorb a shock. And that's when bad things tend to happen. When things are easy, when the Fed's printing money, liquidity is abundant, you tend not to see problems. Most of the time they arise when things are slowing. That's why you always need to kind of think more defensively when the economy is slowing. And so back to the ISM manufacturing index, what we see, at least as the last few examples, is that the Fed has responded when manufacturing basically slows to a crawl. So a good example of that, when we look at 2019, as I mentioned, the Fed, the last rate hike was December of 2018. Even though the Fed didn't raise rates again, it was still shrinking its balance sheet. And it was only until the summer of 2019 that the Fed started to cut interest rates. And it did that when the ISM was falling dramatically. So going into 2019, the ISM was at a reading of, in the high 50s, which is pretty elevated looking at it historically. But by the time we got into the summer and the Fed was cutting interest rates, the ISM had dropped to 50. By the time we hit the third and fourth quarter of 2019, the ISM was in contractionary territory and the Fed started printing money. And then going into 2020, the ISM got back into positive territory, and then we got hit with COVID. And once the ISM fell deeply below 50, the Fed started printing money again. The reason why I'm bringing this up, when we look at the most recent reading of the ISM Manufacturing Index for April, we were looking at 55.4. The high of this cycle so far was in the mid 60s, roughly around 64, I believe, late last year. But the peak in economic momentum was in the spring of 21. So we've been slowing ever since, still growing, just at a slower rate. So in my opinion, looking at some of the leading indicators that I track, I think we could be setting up to hit the low 50s by the fall. So kind of my timing where we might see the Fed pivot essentially is sometime in the fall, because from a political standpoint, if the Fed pivots, I think that's enough to get a market rally. Obviously, I think the White House would want to see the market recovering into the November elections. And so the market really won't have a lot of runway if the Fed pivots literally the month before the November election. So, my feeling is probably around August, September, I think we'll be very clear that the economy is slowing. I also think we'll likely have a couple more lower prints in the annual inflation rate in CPI. And so I think that would be enough to give the Fed cover to pivot. The question is, does that pivot happen earlier? Does something break prior to that? So because nothing is broken, there's no front page news, because manufacturing hasn't quite slowed to a crawl, I don't see any reason right now why the Fed would not continue raising rates as aggressively as being priced in the market at this point. So that's why with the Fed continuing on a tightening path, I think it's too soon to call for a bottom.
Mm-hmm. And really, all of this data that the Fed looks at, they're all really lagging indicators. And you were telling me that the ISM is one of the, in some ways, quickest indicators that the Fed has to look at. Is that right?
That's correct. The ISM we typically get in the first week of the month for the prior month's reading. So in the first week of this month, we got the April reading. So if you think about it, really, there's only a 1 week, maybe, at most, you think about a 2-week lag between when we get the ISM for the prior month. So it's a pretty good real-time indicator. Historically, the market does react very strongly to ISM readings. The reason why is if you look at the annual appreciation of the S&P 500, it tends to track trends in the ISM manufacturing index. So with the ISM trending down, we have seen some slowing in the financial markets, and I don't think we're done. As I mentioned, there are some leading components to the ISM, other indicators that I look at that do a pretty good job of leading the ISM. All of these point to a continual slowdown, not just into the fall, but into the end of the year and possibly even into 2023. So again, the economy is already slowing even before the Fed raised rates for the first time. I mean, as I mentioned, the ISM was in the mid 60s in the spring of 21, and it got down into the mid 50s by the time the Fed raised rates for the first time. So the Fed is tightening into an existing slowdown. So I don't think we've seen who's been swimming naked at this point. We don't know who's going to fall victim to the current Fed rate cycle. And so given there's really, in my opinion, there's really no catalyst for the markets to bottom. There needs to be fiscal stimulus, monetary stimulus. There needs to be some force that breaks the prior trend. And I don't see that. Economically, everyone's slowing down. Commodities remain elevated. There's nothing really alleviating the pain at the pump at this time. The Fed continues to tighten. All of these things are pointing to the trend that's been in place all year continuing. So I still firmly believe that the rally that we've seen is suspect. And the other thing that I track quite frequently is a message that I'm seeing from the credit markets. And the reason why I think they're so valuable is that the credit markets aren't mom and pop investors. It's institutional investors who should have less emotion compared to the retail crowd. And you often see in the midst of a downturn, there's counter trend moves where the market rallies. A good example of that was looking at the 2018 downturn, where we basically had a mini bear market in the fourth quarter. Well, the market peaked late September, early October. And by late October, it staged a pretty dramatic rally into November and early December. But if you look at the stress in the credit markets, as I mentioned, the junk bond market seized up. There was no relief rally at all in credit spreads. They continued to widen and worsen all the way to the point where we finally got the bottom late December. And I've seen that time and time again where markets either go sideways or rally, and the credit markets completely ignore what is seen. And I've seen that all year long. For example, we've had some decent rallies year to date since the market peaked. We had a January rally into February after the initial early January decline. Credit markets continued to deteriorate. And more recently, we had a very substantial rise from March into April, pretty robust rally. A lot of people are saying the bottom is in, but I continue to see, for example, credit default swaps continuing to widen. And I also look at very illiquid structured notes. Basically, these are, securities that are cooked up in the back room by Wall Street. They're very illiquid. They do very well when liquidity is abundant, and they fall out of bed when liquidity is absent. And some of these types of bonds can sell as low as 50, 60 cents on the dollar during a major downturn. And a lot of the ones that I track, they continue to decline, and they're now selling anywhere from 74 cents on the dollar to as low as 70 cents on the dollar. And even with the decent rally we saw begin on Friday and carry over into today, I'm still not seeing any dramatic rally. In fact, for our firm, we're a broker dealer. We've got relationships with over 30 different Wall Street firms. I'm always suspect when I get, millions of dollars of a security being peddled to me and being told what a great deal it is. A good example of that, there's a Goldman Sachs structured note that was selling at the very beginning of the year at 100 cents on the dollar. It fell to around 97 cents. And I was being offered $3 to $5 million of this and being told what a great deal, that it was selling at a 3% discount, had a decent floor in terms of its coupon, and that I should jump on it. And, I passed on that, obviously seeing stress building. I was told in February, these are at 90 cents on the dollar. You have to buy these. I've got a seller looking to dump millions of it. I stayed away from it. And literally the whole way down, I keep having this kind of stuff peddled to me. And even yesterday, I had a different issue. This was a Bank of New York Mellon structured note that someone's trying to sell $3 million to me on. And I wasn't budging. This thing's now at 74 cents on the dollar. And to me, I'm more interested when they're coming to me trying to pull those types of securities, when they're looking at buying. But instead, I'm seeing institutions selling these very illiquid securities, basically trying to stem their losses and draw a line in the sand. So from what I'm seeing in the credit markets, I really do not feel this is over. Basically, even Powell today communicated that the Fed is willing to go above the neutral rate if necessary. So they're very much concerned and committed to battling the inflation rate versus supporting the stock market or necessarily even the economy. And one of the things I kind of did is looking at basically a keyword search in headline news stories. And I went all the way back to 2012 and I looked for 3 different words: inflation, recession, and bear market. So basically looking at what is the dominant concern or theme driving market participants. And what we saw in 2019 and 20, when the Fed printed money and expanded its balance sheet in 2019 and further in 2020, was we saw recession news counts really begin to pick up. And what we saw, though, in the latter part of 2020 was that inflation was appearing more than recession in news stories and headlines. And so as we were coming out of the recession of 2020, that risk was receding, and inflation, in terms of being on front page news, eclipsed inflation late 2020. Well, when you look at where inflation is right now, it is off the charts in terms of dominating the public opinion. Mm-hmm. And recession risk is nowhere close to the prevalence that we saw in 2019 or 2020, or even the word bear market is not at where it was in 2018 or 2020. So clearly, public enemy number one right now is inflation. You're not worried about recession. You're not worried about bear market, because recession, why would anyone worry about it? The unemployment rate is not rising. We have a labor issue, and there's a shortage of labor to meet current job openings. And in terms of a bear market, we haven't officially had one yet. And so when you look at the common person, the working person, not everyone has a portfolio of stocks or bonds, but everyone basically has to eat and drive. And so inflation impacts every single person in the economy. But financial markets, it's not exactly the case. Not everyone has a 401k or IRA. And so inflation really is public enemy number one until that risk comes down. where you get a greater cry of recession risk or bear market, I think the Fed's going to keep tightening aggressively until they break something.
Mm-hmm. So, of course, Chris, we're speaking here on the afternoon of Tuesday, May 17th, just so our listeners get an idea of when we're actually speaking, when you're talking about today. But the other kind of idea that I wanted to touch on when we think about, let's say, debt, the amount of debt that the US has, are we seeing any trends in who is buying the debt internationally? And does this possibly indicate that the rest of the world is losing its appetite for US Treasuries and by extension, maybe the dollar?
No, that's a really good point. That was something I touched on a investment meeting video a couple of weeks ago. Essentially, I was looking at where the big players are. I mean, if you look at China, they've been on a declining trend, basically allowing some of the treasuries to roll off and mature. You look at Russia, obviously they dumped their treasuries a while ago. And so there's a big issue where the Fed has been the predominant buyer of our debt. And, part of the problem and why I felt the Fed was in 2019 going to have to basically quit shrinking their balance sheet, and if not raising the amount of their balance sheet expansion, was we had the Trump tax stimulus, during that time period. And so the budget deficit widened, which meant the Treasury had to issue even more debt prior to the Trump tax stimulus. And so we were issuing more treasuries at the same time the Fed was stepping away. So we had a big buyer leave even while the Treasury was issuing more debt. Well, fast forward to today, I believe last I looked, we had something like $6 trillion of debt coming due. That's just what's maturing, not alone the amount of debt that the Treasury will have to issue to cover the budget deficit. So we have literally trillions and trillions of debt coming due. If memory serves me correctly, I think we have more than $1 trillion come due in May, June, and July. So I think that was probably one of the reasons why the Fed is ramping up the reduction of its balance sheet versus starting right out of the gate at their max, which is roughly around 100 billion a month. So there is a clear issue that what's going to happen to the Treasury market if the Fed steps away, China steps away, Russia steps away. That's a big question of who's going to buy the debt. And often at times, whenever this question arises, more often or not, the U.S. economy slows. So then you get investment demand coming into treasuries because people are worried about an economic recession. And so you see people piling into treasuries. And that may happen again. I mean, as I mentioned, we're seeing a slowing economy. And if it slows enough, people, at least investors, will start worrying that the Fed will tighten too much, push us in a recession, which is deflationary by nature. And we could see long-term interest rates peak. In my opinion, I do believe that they're in the process of peaking right now. I don't know how much more they could really rise.
So, Chris, in this environment where we see all of these risks, is there anywhere that you see a safe haven asset to get through some of this volatility and risk?
There's honestly nothing better than cash at this time. I mean, everything is losing purchasing power to inflation, but when you're in a downturn, it's not how much you make, it's how much you protect. The winners, those that go down the least. So if you think about it, if you put your money in cash, well, yes, you're down minus the inflation rate, but what if you put your money in the stock market? I mean, if you look at the S&P, for example, the S&P year to date is down roughly 15%. Tack on the real value of that decline, things get ugly. Or even looking at the bond market. Long-term treasuries, I believe at one point were down over 20%. So for me, I think cash is the best asset right now. There's no volatility in cash. Your dollar's not going to change. Its purchasing power may, but the nominal value will not change. Well, you can't say that for other securities. And so, you want to have cash available for when the bottom comes. When something breaks and the Fed pivots, that's when you want to have cash to be able to go in and scoop up a lot of the blue chip companies and bargains that are out there. But absent that, in my opinion, for us and our clients, we own gold, we own silver, and I believe we're going to see a major advance in gold, in my opinion, in the back half of this year. And the catalyst for that, in my opinion, will be the Fed capitulating, which will likely lead to a significant top in the US dollar. And as expectations of future Fed rate hikes evaporate, I think so too will the dollar. I mean, we've had record trade deficits. We've got massive budget deficits. All of these forces have long-term secular bearish influences on the dollar, and why I am not a bull on the dollar longer term, particularly given the significant declines that we've seen in foreign currencies. They've become pretty cheap relative to the dollar. Some foreign currencies at 2-3 decade lows relative to the dollar. So that's partly why I think gold, which is, in my opinion, given if you told me what the dollar was going to do this year in the last 12 months, I personally would have expected gold a lot lower. So I think that really speaks to the underlying trend supporting gold. And once we do see a dollar peak, I think the moves will be pretty explosive. The tough part for Americans looking at gold, we're looking at it in dollar terms. But when you look at it in other foreign currencies, gold is doing quite well in other foreign investments. And so from that perspective, I do think that we're going to see a Fed pivot at some point when something breaks. And I think that will be the major catalyst to see gold start to do well in the back half of the year. And as I mentioned too, I think inflation is going to remain sticky. We haven't solved the commodity shortage problem. Russia and Ukraine hasn't been resolved. We've already missed the wheat harvest season for Ukraine, or planting season. And so we already know we're in store for rampant food inflation, energy inflation. And to me, gold is a good hedge and protection against inflation.
Excellent, Chris. Well, I think that kind of wraps up this conversation pretty well for today. Of course, we can find more from you, including your weekly investment meetings at financialsense.com. Tell our listeners a little bit about what you guys have to offer there.
We're a full service firm, so we offer financial planning as well as investment management. And one of the benefits that we have is we have our own broker dealer as well as our registered investment advisor, which gives us flexibility where we're more in control of what we can invest and how much versus being told, how to invest for our clients. And we truly feel that we can do what is best for our clients. And that includes the ability to buy physical gold as well. So if you are interested, please give us a call at 858-487-3939, or you can visit our website at Financial Sense online.
Excellent, Chris. Thanks so much for your time today.
Absolutely. I appreciate being on.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.